The storm desk. Read the storm, book the roofs. You just booked a record month. The crews are slammed, and on Wednesday, someone asks the question that ruins the week. Can we make payroll? The jobs are profitable. The account is dry. Materials and payroll went out this week. The customer check and the insurance money land weeks from now. By the end of this, you'll know how to write a cash flow policy your managers actually follow, so the money stops arriving in the wrong order. Profit is an opinion. Cash is a fact on a Tuesday. Start with why roofing breaks even when it's winning. You buy a whole job of shingles up front. You pay the crew the week they tear off. Then you wait. A retail roof waits on the final check. An insurance roof waits for the actual cash value. Then the depreciation after the work is verified. That gap between cash out and cash in is your working capital hole. Grow fast, and it grows faster than profit. This is not advice. Have your CPA and attorney set the specifics. Before any rule, lock the words. Most cash fights in a roofing company are vocabulary fights. One manager calls a signed contract money. Another calls a sent invoice collected. Give your team 6 states of cash. Confirmed cash cleared the bank. Expected cash has a date and a named person chasing it. Blocked cash is owed but can't be counted yet, with a reason. Committed spend is approved and going out. Proposed spend wants approval. Emergency spend protects people or an active job. 6 words turn a chaotic Friday huddle into a fast meeting. Policy 1. A deposit and draw schedule that funds the job before you do. The biggest cash lever in roofing is when the customer pays relative to when you spend. Set it badly, and you finance every roof with your own money, while suppliers expect to be paid now, so tie each draw to the moment your cash leaves. A deposit covers materials and permit before you order. A progress draw at dry-in, when the roof is watertight, covers that week's payroll. The cash arrives just ahead of each outflow. You're not the bank anymore. Insurance jobs follow the carrier's money, not yours, and that's where managers get into legal trouble fast. Here's the line, and it is not subtle. The homeowner files and owns the claim. The insurer decides coverage. Your company documents the roof and writes an estimate that supports the homeowner's claim. Never offer to waive, rebate, or absorb a deductible. The deductible is the homeowner's to pay, and covering it is insurance fraud in many states. Never promise to handle, fight, or get a claim approved. Managing a claim is unauthorized public adjusting. Document, don't diagnose the claim. Now put one sentence at the top of Policy 1. No material is ordered, and no crew is scheduled until the deposit has cleared and the next draw's trigger is in the file. That single rule kills the most common roofing cash mistake, ordering specialty metal against a contract that's signed but not funded. Keeping it honest depends on chasing real work. That's where Roof Predict fits. It pairs an estimated roof age range, a band, not an exact date, with storm physics modeled per home to flag which houses are likely due. It does not inspect, diagnose, or decide coverage. It just sharpens where you point the outbound. Policy 2. A rolling 13-week cash calendar. The deposit policy fixes one job. The calendar fixes the whole company. 13 weeks is 1 quarter. Long enough to see a slow stretch or a tax deadline coming. Short enough that the numbers are real. List every inflow and every committed outflow by the week. It actually moves cash. Deposits, draws, insurance releases, retainage against supplier bills, payroll, taxes, rent, debt. Mark each row with one of your 6 cash states. It runs weekly because payroll and material drops hit weekly. Any negative week forces a decision now. The calendar is only as honest as the paper behind it. A signed contract is not collected money. An invoice sent today is not cash in the bank. If a row can't show a date and a named owner, it doesn't count as expected. It sits in blocked until someone fixes the reason. And tie every line to a source document, the way the tax record-keeping standard expects records to support income and expenses. If a manager says cash is coming, the office clicks straight to the contract, not faith. Policy 3. Cash gates on every job. A gate is a checkpoint a job must clear before it advances. A job that fails a gate stops moving until it's cleared. Gate 1, contract and deposit cleared, not a check that's coming. Gate 2, material and labor approved against a funded plan. Gate 3, change order control, where margin quietly dies. Price the change before the work, and it's not negotiable after the wood is on the roof. Gate 4, invoice and collection readiness. Gate 5, the closeout margin review. Gate 4 guards 2 things, your lien rights and your collection clock. In most states, the mechanic's lien deadline runs from the last day you worked, and unpaid retainage usually doesn't extend it. So track each lien deadline as a hard date, with a construction attorney setting your state's rules. Then make collections a written process, not a personality. Days sales outstanding, the time from invoice to paid, sits in the 60 to 90-day range, against 30 to 45 elsewhere. A reminder at 5 days past due beats a panic call at 60. Policy 4. Written manager approval limits. A policy without limits is a suggestion. Define in writing what each manager can approve alone and how exceptions get logged. Every category gets a dollar limit and an escalation path. And here's the trap that sinks cash-squeezed shops. Payroll tax timing is not a cash cushion. Withheld income tax, Social Security, and Medicare are trust fund money, not yours to borrow. The late deposit penalty climbs from 2% to 15%, plus interest, and unpaid trust fund tax can become a personal liability. Those dates are fixed, non-movable outflows. Debt and supplier credit are owner decisions, never a field call. A production manager doesn't open a new supplier account or sign equipment financing, and every exception gets logged the same way. Date, approver, amount, job, why it was necessary, the recovery plan, and a review date. A few a month is normal. The same manager logging it every week is a signal. The log turns a vague feeling into a reviewable list. Policy 5. A weekly cash review with one named owner. The first 4 are rules. This is the heartbeat that keeps them alive. Name one person who answers cash questions and approves exceptions. Run a 20 to 30-minute meeting, not an hour of storytelling. Confirmed cash today. Expected inflows over 13 weeks. Blocked cash and who's clearing it. Payroll and tax dates. Jobs missing a deposit. Then 1 or 2 decisions. As the policy matures, it builds a reserve. Lenders point toward 2 to 4 months of operating expenses. That reserve lets you say no and plan for the season, not just the week. Roofing revenue is lumpy. Most of it lands spring through early fall, while fixed costs run through a slow winter. So forecast the slow stretch months ahead. Build the reserve in storm season to spend it down in winter, and set winter staffing before revenue drops. A working capital line of credit, a revolving line that bridges paying crews now against collecting later, earns its place, but only as a planned bridge arranged before the season, owner approved. Used to paper over a structural shortfall, it just adds interest. Close the loop. Profit is an opinion. Cash is a fact measured on a Tuesday. 5 policies put it in the right order. Deposits fund the work before you do. The 13-week calendar shows the wall before you hit it. The gates stop bad jobs from moving. The limits keep spending and payroll honest. And payroll tax money is never yours to borrow. The weekly review catches the problem while it's still a decision, not a crisis. Point your outbound at the roofs that are actually due. That's the difference between booking a great month and keeping them.